In today's economic landscape, managing finances effectively is more crucial than ever. Companies across the globe face the pressing challenge of maintaining liquidity while fostering growth. Asset finance emerges as a strategic solution, allowing businesses to convert fixed assets into working capital, reduce taxes, and optimize expense planning. Despite its advantages, many businesses grapple with fundamental questions about asset finance. How does it work? What are the risks? How can it affect my business's bottom line? Today, we'll explore these questions and more, drawing on the latest financial data and insights from industry leaders. We'll also tackle the most common queries we've received from viewers like you. What is asset finance? Asset finance is like a helping hand for businesses to get the equipment they need without breaking the bank. Whether it's vans, machinery, or even software, asset finance lets you spread out the cost over time. Instead of forking over a huge chunk of cash upfront, you make smaller payments over a fixed period. There are different flavors of asset finance. One common type is equipment leasing, where you essentially rent the equipment for a period. Another option is hire purchase, where you pay in installments and eventually own the asset. The cool thing is, asset finance can also help you unlock the value of stuff you already own. Let's say you've got some equipment or even some intangible asset like software. You can use that as collateral to get a loan. This is called asset refinance. Merchant cash advances are another option, especially handy if you don't have a ton of assets or a long credit history. It's a bit easier to qualify for these, and they're popular with all sorts of businesses, from solo ventures to big companies. The kinds of assets you can finance are cars, heavy goods vehicles and trailers, plant and machinery, construction equipment, print and packaging machinery, waste and recycling, buses and coaches, agricultural and forestry equipment, and more. These are called hard asset, and soft asset are less durable assets, including IT hardware, software packages, catering equipment, office furniture, and security systems, which may have little saleable value by the end of the finance agreement. So whether you're a small outfit or a big player, asset finance has got you covered. It's all about getting what you need to grow your business without the headache of huge upfront costs. What types of asset finance are there? Let's break down the 5 main types of asset finance in a simpler way. Hire purchase, HP. Imagine buying something for your business, like a new kitchen or furniture for your home, but instead of paying all at once, you pay in smaller bits over time. That's hire purchase. You own the thing once you finish paying for it, but until then, the provider still technically owns it. You're responsible for taking care of it. Finance lease. Here, a leasing firm buys something your business needs and rents it out to you. You pay rent each month until you cover the cost plus interest. You can choose to extend the rental, return the item, or sell it to someone else with the leasing firm's help. You're in charge of insurance and maintenance. Equipment leasing. Similar to finance leasing, but with the option to own the equipment at the end of the contract. You rent it for a fixed time and make regular payments. The leasing firm handles maintenance. At the end, you can keep leasing, return the item, upgrade, or buy it outright. Operating leasing. Like finance leasing, but for stuff you only need temporarily or don't want to own. You rent it for a short or medium term and can upgrade it during the rental. It might be cheaper because it's for a shorter time, and maintenance is usually the lessor's job. Asset refinance. This has 2 parts. First, you use your assets as security for a loan, which can help you get lower costs. Second, you sell a hard asset for a lump sum, then lease it back, allowing you to get cash while still using the asset. At the end, you may choose to keep leasing, walk away, or buy it back. Contract hire. Vehicle asset finance. Perfect for businesses needing vehicles without the hassle of managing a fleet. The provider finds and maintains the vehicles, and you pay regular installments. They handle getting rid of the vehicles when the lease is up. Asset finance requirements. Lenders need documents to figure out if you're eligible for a loan and how much they can offer you. The exact paperwork varies depending on the lender and loan type, but there are some basics you'll always need. Identification. You'll need something like a driver's license, passport, or Medicare card so the lender knows who you are. Cash flow projections. This helps the lender see what you own and owe. You might also have to provide bank statements, Cash flow statements, balance sheets, profit and loss statements. For equipment loans where you don't need a lot of documents, low doc loans, you might only need to give a statement about your income from either yourself or an accountant, or a statement showing you can afford the loan. Advantages. What are the benefits of asset finance for businesses? Well, spreading the cost of big-ticket items over time is a big plus, but there's more. Lower initial costs. You don't have to pay a huge sum upfront for expensive items. Fixed payments. Having fixed payments helps with long-term budget planning. Maintenance covered. The lender might handle costly servicing and upkeep. Depreciation risk. If the item loses value or breaks down during the agreement, the provider might handle it. Flexible capital. Instead of tying up capital and buying assets, you can use it for other important business needs. Lower interest rates. Asset finance often offers lower rates compared to other types of borrowing like bank loans or overdrafts. Accessibility. Whether you're a big or small business, in any industry, you can usually access leasing or hire purchase. What about the downsides of asset finance? Uncovered damage. If maintenance doesn't cover all damages, you might be left footing the bill. Repossession risk. Missing payments could lead to the lender taking back the equipment, which could disrupt your business. Ownership uncertainty. With leasing or hiring, you may never actually own the item, even after paying for it. Long-term commitment. Asset finance usually requires terms of at least a year, so it's not a quick fix. Potential cost. In the long run, it might be more expensive than buying outright, especially with deposits or advance payments. Credit checks. Applying for finance involves credit checks, which could affect your credit report if done too frequently.